When looking to protect your investments against inflation, Treasury Inflation-Protected Securities, TIPS, can be a valuable option to consider. These government-issued securities are specifically designed to help safeguard your purchasing power by providing returns that are linked to inflation. While TIPS offer a unique set of benefits, there are also factors that investors should understand before incorporating them into their portfolios. This video will explore the top 10 things you should know about TIPS, including how they work, their pros and cons, and how they can fit into your overall investment strategy. 1. What are TIPS? Treasury Inflation-Protected Securities, TIPS, are bonds issued by the U.S. Department of the Treasury that are designed to protect against inflation. Unlike traditional bonds, TIPS offer a fixed interest rate that is adjusted for inflation. This means that the principal value of TIPS increases with inflation, as measured by the Consumer Price Index, CPI, and the interest payment you receive is based on the adjusted principal. This unique feature ensures that the purchasing power of your investment is preserved over time. How TIPS work: TIPS are issued in a range of maturities, including 5-year, 10-year, and 30-year options. When you invest in TIPS, the initial investment is guaranteed to increase with inflation over the life of the bond. The U.S. Treasury guarantees that your principal investment will rise with inflation, even if inflation rates spike unexpectedly. As a result, TIPS offer a built-in hedge against inflation, making them attractive to long-term investors concerned about rising prices. 2. TIPS provide inflation protection. One of the primary reasons investors turn to TIPS is for inflation protection. Over time, inflation erodes the purchasing power of money, which can negatively impact the value of traditional fixed-income investments. For instance, if you invest in a standard bond with a fixed interest rate, inflation may reduce the real value of your interest payments. TIPS, however, provide an inflation-adjusted return that keeps pace with the rising cost of goods and services. How inflation adjustments are made. The inflation adjustments to TIPS are made based on changes in the Consumer Price Index, CPI, a widely used measure of inflation in the U.S. The principal value of TIPS is adjusted by the percentage change in CPI, which ensures that the bond's value rises in response to inflation. This makes TIPS an effective tool for protecting your investment from the eroding effects of inflation over the long term. 3. TIPS offer a fixed interest rate. In addition to inflation adjustments, TIPS also pay a fixed interest rate, which is known as the coupon rate. However, unlike traditional bonds where the interest payment is fixed based on the original principal, the interest payment on TIPS is adjusted based on the inflation-adjusted principal. As inflation increases, both the principal value of the bond and the interest payments increase, providing a consistent real return on your investment. Understanding the coupon payment: the coupon payment on TIPS is calculated by applying the fixed interest rate to the inflation-adjusted principal. This means that as the principal value increases with inflation, the amount you receive in interest payments also increases. For example, if you purchase a TIPS bond with a fixed coupon rate of 1.5%, and inflation causes the principal to increase, your interest payments will be calculated based on the new, higher principal amount. 4. TIPS are backed by the U.S. government. TIPS are issued and backed by the U.S. government, which makes them a relatively low-risk investment. The U.S. Treasury guarantees the repayment of both the principal and interest on TIPS, which provides a high level of security for investors. This makes TIPS an attractive choice for those looking for a stable, low-risk investment, particularly in uncertain economic conditions. The safety of TIPS. The fact that TIPS are backed by the U.S. government means they are considered one of the safest types of bonds available. This makes them an appealing option for conservative investors who are seeking protection against inflation while minimizing credit risk. Since the U.S. government has a long-standing history of repaying its debts, TIPS are viewed as a secure investment, even in volatile markets. 5. TIPS can be purchased through Treasury Direct or brokers. Investors can purchase TIPS directly through Treasury Direct, a government website that allows individuals to buy U.S. Treasury securities, or through brokerage firms. Treasury Direct provides a simple and convenient way for individual investors to buy TIPS directly from the U.S. government, without the need for a middleman. Alternatively, investors can buy TIPS through a broker, which may offer additional features, such as the ability to trade TIPS on the secondary market. Buying TIPS through Treasury Direct To purchase TIPS through Treasury Direct, you'll need to set up an account on the website. Once your account is set up, you can participate in regular TIPS auctions where the U.S. government issues new securities. TIPS are sold in denominations as low as $100, making them accessible to a wide range of investors. 6. TIPS can be taxable. Although TIPS provide inflation protection, they are not tax-free. The interest income generated by TIPS is subject to federal income tax, and any adjustments to the principal due to inflation are considered taxable as well. The inflation adjustments to the principal are treated as income, even though the investor does not receive that amount until the bond matures or is sold. Tax implications of TIPS. The tax treatment of TIPS can be a downside for some investors. While TIPS provide a real return that keeps pace with inflation, the taxes on inflation adjustments can create a tax burden, particularly for those in higher tax brackets. To mitigate this, some investors hold TIPS in tax-advantaged accounts, such as IRAs or 401k plans, to defer taxes on the inflation adjustments. 7. TIPS can be affected by deflation. While TIPS are designed to protect against inflation, they can be affected by deflation, when the general level of prices in the economy falls. In the case of deflation, the principal value of TIPS can decrease, and your interest payments may be lower. However, even in a deflationary environment, the U.S. government guarantees that the principal value of TIPS will never fall below the original face value. Deflation and TIPS. In the rare event of deflation, the principal value of TIPS may decrease to reflect lower prices. However, the U.S. government guarantees that the principal value will never fall below the original investment amount. This means that even if inflation turns negative, your investment in TIPS will still be protected against significant losses. 8. TIPS are a long-term investment. TIPS are generally considered a long-term investment, with maturities ranging from 5 to 30 years. The inflation adjustments and interest payments accumulate over time, which makes TIPS an attractive option for long-term investors seeking to preserve the purchasing power of their assets. For those with a long-term investment horizon, TIPS can provide a steady, inflation-adjusted stream of income. The benefits of long-term TIP. One of the key advantages of TIPS is their ability to provide consistent returns over time, even in a changing economic environment. As inflation rises, the value of the principal and the interest payments on TIPS will increase, providing a hedge against rising costs. For long-term investors, TIPS can offer a secure and reliable source of income that grows in line with inflation. 9. TIPS are useful for diversification. Adding TIPS to a portfolio can help diversify risk, especially in periods of economic uncertainty. TIPS tend to perform well during inflationary periods, and they often have a low correlation with other asset classes such as stocks and traditional bonds. By including TIPS in a portfolio, investors can reduce the overall risk and increase the potential for stable returns, especially in times of market volatility. TIPS and portfolio diversification. TIPS can provide diversification benefits because their returns are linked to inflation, which behaves differently from other asset classes. During times of rising inflation, traditional bonds may underperform, while TIPS are designed to keep pace with inflation. This makes TIPS a useful tool for reducing overall portfolio risk, particularly in inflationary environments. 10. TIPS are not for everyone. While TIPS offer a number of benefits, they are not suitable for every investor. For those who are primarily focused on short-term gains, TIPS may not provide the same level of returns as riskier assets such as stocks. Additionally, because of the tax implications and the potential for deflation, TIPS may not be the best choice for every investor. It's important to consider your individual financial goals, risk tolerance, and time horizon before incorporating TIPS into your portfolio. Assessing the fit of TIPS in your portfolio. Before investing in TIPS, it's essential to assess whether they align with your investment objectives. TIPS are most beneficial for investors seeking inflation protection over the long term, particularly those who are looking to preserve purchasing power during periods of rising inflation. If you're investing for short-term goals or are primarily focused on capital appreciation, other investment options may be more appropriate. Treasury Inflation-Protected Securities, TIPS, are a powerful tool for protecting your investments against inflation, offering both principal protection and inflation-adjusted returns. While they come with certain tax implications and are better suited for long-term investors, Tips can play an important role in preserving your purchasing power over time. Understanding the mechanics of tips and how they fit into your investment strategy is crucial for making informed decisions about their use in your portfolio. By keeping these 10 key points in mind, you can ensure that tips are a beneficial and strategic addition to your financial plan.